So the big question is this: how are real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we grow a real estate business conservatively to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground.
This is the Real Estate Underground podcast show number 63.
Greetings and salutations, Real Estate Undergrounders. This is Ed Matthews with the Real Estate Underground podcast. Today, I am actually speaking with Becca Hintergardt of Hint Investments. One of the things we've realized as we were getting ready for this call is that we probably worked in the same neighborhoods back in the Bay Area way back when I was a techie and she was a medical device executive. And so small world. But Becca, welcome to the show, and thank you so much for your time today.
My pleasure, Ed. Thank you so much for having me. It's a
Absolutely.
pleasure to be here.
So one of the things that I was absolutely fascinated by, you have a report that's out, and we'll talk about it in detail a little while, but talking about working or moving internationally, working internationally and investing in real estate. And so, one of the things that I was curious about in your operation, obviously you've had a career where you've, I assume been all over the country and possibly all over the world to work. And, you could have done anything. There's a lot of asset classes, technology, medical technology, obviously multifamily, and you chose real estate. And I'm curious, what drew you into the real estate world as opposed to, some of the other places where you could apply that big brain of yours?
Right. Well, I guess the motivation initially was I needed a tax deduction. I was,
there you go.
and I needed a place to live, those
Right.
two things. So I bought my first property in San Francisco, a duplex in San Francisco, which was a house hack. And that provided both the tax deduction and the passive income from the lower unit while I lived in the upper unit. So it was sort of by default.
Yep.
And and that experience from that building made me realize the power of passive income.
Absolutely.
And I fell in love with real estate from then forward.
And so I'm just curious, how long ago was that?
Oh my gosh, that was, a while ago. I mean, that was 18 years. I had the building for 18 years. And this was a place that, I'm glad I did it then. I would never do it now. It was a tremendous lift, an old Victorian building in San Francisco that's, 2 inches crooked from one side, from the left side to the right, as these old Victorians in earthquake towns happen to be. And, we blew out the back side and rebuilt the whole back and put supporting beams in the garage to have a garage and charge another $500 rent, and just a massive, tremendous, huge lift and a condo conversion. I'm glad I did it, but there's an easier way. And so from then forward, I said, okay, this real estate business, I don't want to be the only one out there doing this, the lone wolf, the do-it-yourselfer.
Right.
I know there's another path to this.
Absolutely.
With syndications and passive income. And so the quest began.
Yeah. And so, obviously, one of the things that I've realized over the years, I started with a 4-family, so we were kind of kindred spirits, and that was a heavy lift for me. And, and now I've gotten into syndication, and, one of the things that I've realized is that the process to buy a duplex or a 4-family is the exact same process you'd take when you're buying, a 150 unit building somewhere else. Right. And so, obviously there are, different team members, there's more team members, right? As well as, you've got to put your business systems in place and have your technology platform to manage your relationships with your residents as well as your contractors. But I'm curious, how did you make that leap? I know, I've been doing this for almost, 15 years. And you've been doing this for about 18 years. And, there is a growth process, right? And, there's also that snowball effect of, hey, a duplex, let's get a 6-family next. And then, well, that was easy. Why don't we do a 20 unit, right? And so I'm curious, what was that process for you as you grew into being a capital raiser and a syndicator.
Right. Yeah. And it very much is a journey. It's kind of getting your feet wet. And a lot of people start out with small multifamilies or single family homes.
Yep.
And it's a lot of work at that level. Um, and often a little bit of do it yourself is put into there as well,
Yep.
which is a tough road and not really very scalable. So after that duplex, I did a 12 unit in multifamily. So taking the trajectory exactly as you said, you kind of level up.
Right.
And that was, I bought it on a short sale out in Kansas City. And that was great for a while. But a lot learned there. I call that my training ground because there was many things went wrong, including the property manager in charge of the whole thing.
Yeah.
So, and what I also learned from that is, I don't want to be the lone wolf out there. Those two experiences from the being the sole owner, and especially a sole owner out in a state that's not where you live, is pretty tricky. Also, even if you start with money in this business, you eventually run out. So you're looking for partners.
Right.
So from there, I realized partnering up, passive income investing, scaling my portfolio was going to be the way to success. So I began investing in as a limited partner in other syndications, just to sit back and kind of an armchair approach and watch how these things are done.
Right. Smart.
Yeah.
And so, as you grew from that 2 unit to the 12 unit into limited partners, I'm curious, what were those first LP roles? What were those investments like in terms of size and area and all that?
Yeah, well, actually, I'm kind of the crash test dummy of real estate investing, I think, because now that you're asking, it didn't go well.
Yeah.
That first passive deal actually went kind of sideways.
Okay.
So, and I sat back going, I am so glad I'm not on the general partnership here. I'm just as passive investor watching this train wreck take place in front of me. But I learned a lot. And one of the things I would have done better is know the sponsors a lot better and vet them. I met these people at a real estate syndication conference, and they had a deal and it looked good and everybody seemed nice. But in hindsight, there were a lot of red flags wrong with their business plan. And I mean, I could go on and on about it.
I'd love to learn more about that. So when you met these
okay, I will.
unnamed...
the war stories.
Yeah.
You'll be sorry.
I learned just as much from my mistakes as I do from my successes. I actually submit I learned more from my mistakes than my successes. But
I agree.
Yeah,
forget them. That's for sure. Right.
That is for sure. And, I think they're great opportunities to learn and get better. Right. So with regard to these red flags, was it that the syndicator was inexperienced and they were overestimating their abilities, or was it something else?
Well, they were fairly, moderately experienced, I would say. But there were some key things that they didn't consider. One of them being the renovating the clubhouse and putting in a bathroom that would require the American Disability Act's compliance. And it's extremely expensive. Anybody who's dealt with that before.
Right.
We would deal with this in hospitals. My husband and I were medical device reps selling CT and MRI scanners. The cost to put a bathroom in our home, I don't know, $7,000. To put a bathroom in a hospital with the American Disability Act clearance, everything you need, is almost $200,000.
Holy moly.
So it's a tremendous difference.
Yeah.
So yeah, that's one of the things they did terribly wrong. And then, do you remember in Rich Dad, Poor Dad, the Purple Bible that everybody's read? There's a point where Robert Kiyosaki was going to buy his first investment, as I recall. It was a condo in Honolulu. And he said to his rich dad, I'm going to buy this. And his rich dad said, well, do you know that there's a massive public works project, a sewer replacement in front of that property? and it's going to take many, many months. And then what you can plan on is another 6 months beyond what they say, because they often take too long, and then they run out of money and need to go seek money. And that's exactly what happened, if you recall, in that book.
Yes.
So he went back, he passed on that, bought another one on another street, and then went back to that first condo and bought it in a distressed sale for like half the price.
For pennies. Yes. Brilliant.
Right.
So what did,
so on our passive deal, that's kind of what happened. There was a massive public works project in front of the building. It was a sewer line replacement. It took months and months and ran out of money. They had to go back for more money. It blocked the entrance of the property such that it's like a 3-lane road to get in, and you have to turn your car so far to the right and almost flip your car to get into the driveway during our lease up.
Oh my
goodness. So people that were living there were trying to leave, let alone trying to rent it up.
Right.
Lease it up. So I mean, it was one of about 5 things that went sideways.
Wow.
On that.
So from your perspective, when you're evaluating property today, knowing that experience, right? How would you avoid that? If, let's say you're obviously at that point you were in the Bay Area, you're looking in hypothetically Kansas City, without getting on a plane, I assume you did anyway, but how are you able to uncover something like that when you don't have access? You're not living there. You're not driving by that property on a daily basis.
Right.
Stay with us. We'll be right back.
A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
Right. Well, you need to look in this when you do your research on the property. You need to look into the city and what kind of things are planned. These things are posted, as well as what kind of new developments are going up.
Yes.
Another thing with that was we were underinsured. I mean, we were insured, but we weren't insured for the degree of the slip and fall that happened later. So you really need to check the insurance.
Yeah.
I mean, there's a lot to this. And what I wish at that time, Ed, is I had somebody to vet these deals for me. Because who has time for all this, right? You're working your W-2 job, just trying to get enough money to put food on the table for get by. And, who has time to go into the city of Texas and figure out if there's going to be a sewer line replacement in front of the property? You need someone to do this for you.
Yeah. And so do you have someone that you count on to do all your underwriting right now?
I have somebody for underwriting, yeah. But what I do, my business model has stemmed from my experience as a passive investor and things that went sideways. And I vet these deals for myself and my passive investors. And we go into these deals together as sort of a Groupon approach, and everything's well vetted, three rounds of underwriting.
Yeah.
And I have my checklist based on my past experiences.
Yeah. Smart.
Good and bad.
Yeah. And that's good though, because so one of the ways, in addition to looking at the city or town's 10-year plan, the other thing, and I got this actually from my mentor, Charles Dobbins, that, he got me to, the target markets. We actually subscribe to the local newspapers as well. Mm-hmm. And so, we know about the convention center that's being considered down the street, and the street work and infrastructure work that's coming 6 months down the road that, you wouldn't know about if you didn't pick up our hometown Times. And so, there's a lot you need to do in order to protect your investors and obviously protect the asset, right?
Absolutely.
Smart. And, insurance is one of the things that, in my experience, almost everyone gets wrong. Right. Mm-hmm. And it's because they underestimate, not only they may overestimate the value of the building, but underestimate the replacement cost of the building. And if something bad happens, you and your investors are on the hook, and you've got a problem if, you have a building that is going to take $5 million to replace, and you have it insured for $3.5 million because you only paid $2.5 million for it, right?
Right.
Scary.
Yeah.
Yeah.
I mean, there's a lot of boxes to check in this, and the typical passive investor isn't going to do all of these. So
Right.
it's best to align yourself with someone that will.
Absolutely. Okay, so we've gone from the duplex to the 12 unit, and we moved on to the limited partnership where, and it may have been more than one, that you invested in. How did you make the jump? When did you know you were ready to make the jump from limited partner to general partner and run and sponsor a deal yourself?
Yeah, it actually took a little while, may I say, because those two experiences were not great.
Okay.
And I was loathing and self-doubt, thinking maybe I got this wrong. Maybe this business wasn't for me. How could I, miss these key points?
Sure.
So I sat it out for a little while. I have two kids 18 months apart that really occupied quite a bit of my time. So it was a good time to sit it out and see what happens in the real estate market.
Yep.
But it took a bit to sort of get back on the horse, as they say.
Yep.
I joined a mentorship, and that was very helpful in building my confidence again that it wasn't anything. I mean, there were some things I did wrong, but things just happen.
Right.
Things happen in real estate.
Sure.
And setting up the correct systems to make sure that I'm assured that doesn't happen again.
Indeed.
And aligning myself with other partners. This is very much a group sport.
Yep.
So the realization of that, from going from owning your own properties to actually a group mindset, is a big jump.
It is,
because you're putting trust in a group, and that's actually a pretty hard step, I had found.
It is, because letting go, it's a control thing, right? But it's also it's a trust issue, right? And so you've got to create those relationships and understand the value systems from which your partners are operating from, and you've obviously got to be transparent about what you're operating from, and also then you've got to figure out, from a goal perspective, are we aligned? Do we all want the same thing, right?
Right.
Yeah.
Right.
And I always used to think to myself, and I've said it out loud as well, as my corporate world days. If I walked into a room of my team and I was filled with my team, and if I was the smartest person in the room, we were all in a lot of trouble. And
find another room.
Yeah, exactly. And that holds true today as well, right? If I walk into a closing room or a conference room, and our team is there, and I'm the one that's expected to figure it all out, boy, are we in trouble.
Yeah. That's right.
Right.
That's right. And especially as you get into these big deals, there's a lot to do. You need professional underwriters. Institutional grade underwriting is what we'd like to see. You need someone boots on the ground in these markets that you're going to be investing in.
Absolutely.
So there's a lot to it.
So when I'd like to, you had mentioned something about a checklist, and I'd love to learn a little bit about that. So when you work your checklist, are you looking at just the numbers, or what are some of the other elements within that underwriting process that you're looking at in terms of, I'm curious about, location and demographics and all the other things that go into underwriting. What are some of the things that you really pay attention to and you think that matter?
Right. Well, it starts with the area. So the idea is pocket listings in good areas. We look for A minus and B class assets, garden style. I'm at the point we don't invest in C class assets anymore.
Okay.
We look at that area. Does the asset match the area? Does that asset class, is it a B property? And is it in a B area, or is it in a C area? Because we certainly don't want that. We're open to C plus assets that are in an A and B area, of course.
So you can reposition it. Yeah, that makes sense.
You could reposition it. But and the strategy is light value add. We're not into very deep value adds anymore. So we look at the area pretty closely. We look at the crime of that area. And the demographic, the income. Then once it passes that, then we begin our underwriting. but half the deals are thrown out just as that alone.
Sure.
So
yeah, if the obviously if the local, per capita income isn't 3x, the target rent, then game over, right? There's no need to
game
keep
over.
looking, right?
Yeah.
You look at a property or a portfolio, and you see that, okay, target location lines up with our vision in terms of what we want to execute. What are some of the other things that you look at, as you dig a little deeper into a property?
Yep. So once it passes all the location parameters, and that includes crime rate, income, does the asset class match the area?
Yeah.
Then we jump into the underwriting, and then that's a whole nother thing. But we have to estimate the taxes and insurance, and in Texas that can be pretty tricky. Texas is one of our primary markets now. We love Texas and Dallas in particular.
Mm-hmm.
There are 10,000 people a month that move to Dallas.
Wow,
most of them
really?
Californians.
Yeah.
It is just insane. So that market
Wow.
just keeps giving. I know. And that's a key factor in what we look for in choosing these markets. Positive migration, population growth, job growth, diversity of income in these markets.
Yep. Smart.
So,
and so, you mentioned a few minutes ago, you used to be in C. I think I inferred that you used to be in C and you no longer focus on C or look at that as potential investments. Is that because, and you also mentioned, light value add. So I have a feeling those two things are related. So I'm curious what made you kind of make the move out of C and focus on, your B plus, A minus type properties.
Yeah, that's a great question. The C class tenant base and asset class is a tough one to manage on many respects. Mm-hmm. The buildings are older.
Yep.
The tenant class is harder to manage in the sense that these are the first tenants to fall upon crisis when there's a financial crisis, as we saw with the pandemic.
Right.
Neil Bawa put out some interesting data on it, and he says, the average C-class tenant has $400 in the bank.
Saw that.
And he's the data guy. Yeah, isn't that interesting? So how are you going to raise the rent $150 or $200 for someone who has $400 in the bank? Right. Well, you can't. So they leave. So then you have, then you have a vacancy upon your turnover, which you usually have anyway. But these older buildings are often there's so many more layers of the onion. It looks good on paper, and you start peeling back the onion, and there's deferred maintenance. And even if you account for that, there's more behind that layer of the onion.
Without a doubt. So
we have just found it to be an easier tenant base and age of building in the B class. Our dream is like a 1980s B class garden style asset in a B plus or A minus area.
Gotcha.
So that we have found to be a lot easier to manage.
Yeah. And so
property managers also, that's another thing, is they prefer B class assets and A's.
Well, it makes their job easier, right?
Right.
Right. So of course they do. So the other thing you mentioned is light value add. So how would you define that in terms of your own business model?
Well, here's how I wouldn't define it. We have a hotel conversion right now in Arizona.
Exciting.
And it's fun. These are really fun hotel conversions. Yeah. They are. I mean, they're deep value add. So it's pretty cool to watch these take place.
Yeah, it's a huge transformation.
Huge. I mean, this was 100-unit Quality Inn that we're taking down to 65 units of multifamily in Arizona. Massive lift. Massive. And that has been a fun project. We bought this for 30 cents on the dollar, so we bought right, but it's a lot of work.
Yeah.
So on the other side of things, with these changing times, kind of with the people talking about a recession, we're not looking to go into really deep value adds. Nothing like that. I mean, maybe a light, paint on cabinets, a little bit of flooring, but no gutting of units and taking it all down to studs.
Right.
Like we're doing with our hotel conversion. One of the deals we just did is in Dallas, which is a kind of a dream deal. It's 536 units in Dallas, B-class asset, and exactly what I'm talking about, light value add.
Right.
Cash flows from the start. So
wonderful. So, the other thing that I think,
peaceful.
yeah, exactly. Right. Almost zen. The, so the other thing I think about when, I hear light value add is, management, right? So, in my tech world, my techie days, I was a procurement and sourcing guy, right? So, I always look at an expense envelope and say, okay, there's got to be a place where I can lower expenses or create economies of scale or, find a way to create NOI. It doesn't always have to be raising rents, although a lot of times it is. It can also be, sourcing your landscaping and sourcing your snow removal if you're in that part of the world, and sourcing your trash removal and, all of that, and being smart about the contractors you hire and, making sure that you hire quality ones, but also really efficient ones. And so, it's activities like that as well. I'm curious what your thoughts are.
I agree entirely. If you can incorporate operational efficiencies into things, then there's your value add right there. And
Right.
I'd much prefer a deal where we could put in operational efficiencies, lower the water bill, look at all the contract services, see if they're being billed properly, increase some of the contract services like, valet trash and cable. So that's the easiest play, of course.
Sure.
Rubs, that's a no-brainer.
Yep, absolutely. Fascinating. So, and so, the types of properties you mentioned, a 530 some odd unit in Dallas. That's a great win. Congratulations. So, in terms of your business today, one of the things that I think I heard you say is, and it was actually prior to us hitting the record button, was, not only are you still a syndicator, but you're also raising capital as well. And I assume, is that more of as a limited partner, or are you, is it more of a fund of funds kind of approach where you're playing a role in the GP? You're bringing a pile of capital to a general partnership. Like, what's your approach there?
Mm-hmm. Ed, my goal is to live my life in Costa Rica on the beach, supported by passive income from real estate.
Amen.
So what I do is I combine my money and investor money in deals that kick off a good amount of passive income for us.
Okay.
So we can all do that.
Yep.
Many of my investors are people that are straddling two lives, in Panama and the U.S. or in Costa Rica and the U.S. And I could talk to these people all day long. I absolutely love it. And we're on about, the same path. It's investing in passive income deals to support our life overseas. Yep. And how that looks for me is in vetting these deals for my investors. I go through all these things in the checklist that we previously talked about.
Yep.
Then I combine my money with their money. And it's kind of a Groupon approach. Bring $1 million to a deal.
Yep.
We choose the best operators in my target market because, you talk to operators and they'll say, okay, what's your best deal? Oh, and they'll tell you. So don't think every deal within that operator is good. They have their favorite child, as we all do.
Sure.
Like, let's admit it, right? So, what I want is the favorite child in each deal. Don't tell my kids. Fortunately, they're at school. But what I look for is the best deal from the most qualified operators in my target market. And then we bring our chunk of cash to that.
Excellent. Excellent. And so you mentioned something that is near and dear to my heart. I was just talking about this with my business coach, as a matter of fact, about what's next. And, one of the things that I had mentioned was, having a business that I could walk away from and it still would operate without me, and send me mailbox money on a monthly and quarterly basis. And it seems like, as we've gotten to know each other, you have that figured out.
Yeah, I'd like to think so.
Well, I'm for those,
at least I'm 80% there.
Yeah. So for those of you who are on video watching this interview, I'm looking at Becca's absolutely stunning backyard. and I'll let you tell everybody where you are. But
Oh,
yeah, I mean, it's she's living the dream that I think a lot of us are aspiring to. So I'd love to hear more about that.
oh yeah, you bet. Well, for anybody on YouTube, this is a snapshot of our backyard in one of the many Airbnbs we stayed in Costa Rica. So what happened during the pandemic, my husband and I, we decided to leave it all behind. We're the white, what was that? The Great Resignation, the white
Yes.
collar workers that told their employers, adios,
See ya.
and took off. See ya. We took off for the tropics. So we sold, and then rented out everything we had, picked up our two kids then in 5th and 6th grade, and moved to Costa Rica. And we lived in a boutique surf and yoga hub in Nosara, Costa Rica, learning how to surf, doing yoga several times a week, and living off passive income from real estate investing.
Amazing.
We were there 80% supported by passive income, primarily from multifamily.
Excellent. That's amazing. And so now that we've progressed through the pandemic, where are you in the world these days? Where do you spend your time?
Yes, it's a tricky equation. We are straddling two worlds right now, both in Costa Rica and then back in the Bay Area.
Gotcha.
We have found that the kids really miss the grandparents that are in their
Sure.
80s. So that's a tricky thing. Our whole family's in the Bay Area.
Yeah.
We love our life in Costa Rica. So we're sort of straddling two worlds.
And
But
have you gone back to corporate America, or have you gotten to the point where your passive income supports you entirely?
no corporate America. I don't think I can ever go back. Once you realize that you're climbing the corporate ladder, but the ladder was against the wrong wall,
Right.
I want to go back to my 30-year-old self and enlighten myself and say, why didn't you think of this sooner? How could we?
Right.
I don't know why we didn't figure this out sooner.
It's okay.
But
With
where
age
I am,
comes wisdom.
it does. You're right. It does. And it's all, you really have to embrace the journey.
Absolutely.
So it's all part of the journey. But where I am now, Ed, is really educating people that this life is possible. You can, within a surprisingly short amount of time, queue up your life to have enough passive income to straddle two lives, to go live in another country half the year if you want to, or the full year.
Right.
And what you'll find when you do that is that things are often a lot less expensive overseas.
True.
So you have the currency arbitrage, where the dollar is pretty strong in other countries.
Yeah.
You have a lower cost of living, certainly a lower cost of healthcare.
Right.
So I have a little email series that teaches people how to do that.
Oh, I'd love to hear I'd love to learn all about that. So it's a report of some sort, I assume, right? Or an email?
It's a report. Yep. That rolls everything up, and then it's an email campaign which will teach you, how to find health insurance in other countries and how to choose your dream destination. But it starts with a quick ebook, which is called 6 Steps to Put Your Income on Autopilot and Move Overseas. You can find that at Hint Investments, so www.hint, H-I-N-T, investments with an S.com. And that will show you a cost of living calculator and how to determine where the cost of living, where you want to go. It shows you some of the best places for expats, some of the least expensive places for expats. So there's various calculators to help people refine this vision. Yeah. So
excellent.
It starts there.
And so when you're not traveling and or straddling your multiple worlds, and you're not investing in real estate, how do you and your husband and your kids, how do you like to spend your time? What else do you do?
Well, we're a pretty active family, so we're learning to surf this year, which is just great. Our
fun.
Kids are good at it, out there ripping the waves. My husband and I were like the geriatric surfers out there, but we're making it happen.
Right. Well, as a fellow geriatric, I admire the fact that you've gone headfirst into a surfing career. So congrats.
Head first.
Yeah,
very,
literally, right?
Very well said.
Literally and figuratively.
Literally.
Right. Well, that's wonderful. And so you had mentioned your website. If folks are looking to learn more about you or Obviously, they have the website to go get that ebook. What are some of the other ways that they can follow your story and learn more about you and get in touch with you if they want?
You bet. You bet. You can find me on LinkedIn under Becca Hint, Hint, or Hintergardt, my very long married last name. It's hard to spell. So look for Becca Hint, probably easier. Or you could email me directly at becca@hintinvestments.com. And I'd love to hear your story and help you calculate how to live this beautiful life straddling two worlds, two countries.
Consider me inspired. I'm gonna download the ebook and I'll probably share it with my wife. And who knows, we may be neighbors someday.
I would love it.
Yeah,
we'll be out there on the waves together, Ed. Wiping out together.
Sounds good to me. Becca Hintergardt of Hint Investments, thank you so much for your time today. It's really been an honor and a treasure and a pleasure to meet with you and learn more about you and your business. And I wish you well in the coming years and look forward to keeping in touch.
Thank you, Ed. It's been such a pleasure. I really have enjoyed our conversation.
Likewise.
Thank you so much.
Thanks, Becca. This has been the Real Estate Underground podcast, a Clark Street Capital presentation. Thanks for joining us. If you're enjoying the show, please remember to subscribe and share it with your friends. If you'd like to learn more about Clark Street Capital and our upcoming projects, please join our investor club at clarkst.com/join. Until next time, happy investing.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.